This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com, and I have with me this morning two distinguished gentlemen this time. Charles Hugh Smith, well-recognized writer on the web and publisher of the website Up to Minds, certainly no stranger to our long-term listeners. Welcome, Charles.
Welcome. Thank you very much.
We also have Bill Laggner with us, who is the co-founder of Bearing Asset Management. Welcome, Bill.
Welcome.
For our listeners who are unfamiliar with Bill's background, he is well recognized in the industry as having had his fund well positioned for the financial crisis and the housing collapse. And maybe by knowing what is on Bill's mind this morning, we can get some insight into what lies ahead. How's that, Bill? Is that a true statement?
That is a true statement, and we're living in interesting times.
In the way of a background, Bill began in the investment industry in the late 80s, initially as a stockbroker, and then moved to the buy side at Fidelity Investments, and he left Fidelity in late 1998 to manage his own investments. Bill cut his teeth on the short side during the tech bubble, and after it had burst, formed Bearing with his fund partner Kevin Duffy in the early part of the decade. So, Bill, you've been able to recognize more than a few major financial problems before the pack did. What's your secret?
Well, I think the real, it's not really a secret. It's just stepping away from the Keynesian lens and viewing the world through an Austrian economics lens. And I think that, the one common denominator over the last, 15 years or so has been a series of bubbles. Of course, the bubbles becoming more and more pronounced. And then, of course, the unwinding of those bubbles, leaving a lot of carnage behind. So, It's looking at central banks, looking at central planning, fiscal monetary intervention, and then the unintended consequences, and trying to recognize that early on and then positioning the fund accordingly.
We've spent a lot of time here talking about the degree of central planning and that migration, what we refer to as monetary malpractice, that is the moral hazard, unintended consequences, and which is resulting in some dysfunctional markets. So I asked Bill to share his thinking this morning with us specifically on what he sees his 2013 themes to be. Bill brought some slides, and I wonder, Bill, if you could, because we're always short of time, you kick it off and get right into what you brought with you.
Okay, yeah, let's start with China, because China has been, over the last, I would call it the last 4, 5, 6 years now, been perceived as, the next economic superpower. And so there was quite a bit of money pre-2008 pouring into Chinese real estate, stocks, and then, of course, the related commodities that they were using because of the entire infrastructure build. And we looked at that and said to ourselves, okay, what is sustainable and real and what is artificial? The Austrian lens. And you could see that it was a very command and control type process whereby the state was promoting build out, and basically you had this fixed investment to GDP bubble that was beyond anything we had seen from any developing country over the last 150 years. So that was a clue that clearly there was a malinvestment, distortions, etc. And the first slide here, you could see this is from Jim Chanos, where he's talking about the real estate economy, private property. Charles may want to comment about private property rights in China, but essentially how you had this huge residential and commercial real estate bubble. And I think the bubble, the speculation, a lot of it after the 08-09 demise has been continue to get fueled, I should say, by shadow banking. Essentially, you deposit money at a Chinese bank and deposit rates are very, very low. You go across the hall to the bank's trust company and they've got structured finance products where they're paying you maybe double or triple what you're getting on deposits. That's the hook. people deposit money in these structured finance investments, and that money then gets loaned out to developers. So the money, and there's a lot of, let's face it, there's a lot of capital in China, and so that money gets, continuously loaned out into this ever-growing real estate bubble. And we actually think that we've reached the point now where property prices are starting to decline, and they're exhausting some of these shadow bank structures, although, of late the numbers have been pretty strong. But I think just like the U.S. property bubble and the Chinese property bubble, once you start to see collateral, this, as Charles loves to call it, phantom collateral, once it starts to get questioned and it starts to decline sequentially, you then go from a raging bubble and speculative environment to one where everyone's trying to get out at the same time.
If I could interject here, I think that's an excellent macro description of China's real estate bubble. And just to add a bit of sort of micro economics to it, what few Americans understand is that households in China have very few alternatives for their extra cash, for their savings. They don't have a lot of investment choices, and its stock market is widely considered rigged in China, and so buying an extra flat or two is considered a wise investment. So you have middle-class families that own 3 flats, and they may not even be renting them out. They're just their savings account. And so you've created there's sort of a funnel effect where there's so few investment alternatives in China that money from households pours into real estate, and it's obviously malinvested, but they just don't have any other place to put their money. And a second point is that local government is not really under the control of the central government. A lot of people think the Communist Party runs everything, every detail, and that's not really true. The local governments have a lot of leeway, and what they do is they generate a lot of their income from selling leases on land to developers. And the government still owns all the land in China. All you're getting is a 98-year lease or whatever. But so the local governments are extremely dependent for their own income for like selling land to developers. And so if the bubble were to pop, the local governments would lose like literally half of their income. And so that's another problem, that there's bubbles on top of bubbles.
Yeah, Charles, you're right. It's actually over 65%. I know we had Bert Dolman on, who's done a lot of work on China, and he's terrified of what he sees. And this whole shadow banking is actually operating in a big part at the regional local government. As you said, it's so separate from the federal government, with the central government, therefore just exploding. And a point I'd make, Bill, is that there's no question the bubble is there, and it's at some point is going to pop. But there's a fundamental difference in this bubble. And the China have practiced the mercantilism game better than Japan and the Asian tigers. So it's taken, ship exported products and brought in cash and those IOUs, which has exploded its reserves through fractional banking. It's been able to pump that money out. And that's where we've got this, what I'll call malinvestment. But difference is that money has went into primarily infrastructure. It's built, yes, and apartment complexes, etc., but it didn't go into building McMansions, yuppie palaces, the kinds of things that we blew our money on, if I could use that, during the 2000s. So when the collapse or resetting comes, and it will come, the Chinese are actually sitting on real assets. And yes, some of them are speculating in flats, but they've got 1.3 billion people needing accommodations, and the government's responsible. So I believe it understands this in spades, so I won't give them more credit for control, because it's practicing such a process now of what the Austrians, you're very well familiar with, of indirect exchange, of now trying to take that fiat currency that's just flowing into them and try and buying. And I see the numbers of agreements and even these new announcements of clearing hubs that they're now setting up to push that out. So there's some troubling times in front, but it's not going to be quite as bad as people might project longer term for China.
Yeah, no, I think that I would agree with you that spending money on infrastructure has some value. Versus building McMansion, 15, 20,000 square foot McMansions like we did here. I would say that to Charles' point about the local governments, and there's a slide we can get to here. I think it's slide 10 or 11, but basically where you had the global financial system called into question, right? The whole structured finance system was questioned. There was a run on structured credit back in 08 and 09 that was really started in the U.S. when housing collateral, phantom collateral started to roll, and a lot of these questionable securities were illiquid, became very liquid, and the Fed stepped in. In the case of China, what's interesting is, you had the unwind beginning in 08 and 09, and the Chinese, of all the various interventionary forces around the world, let's face it, they threw trillions and trillions of new fiat at the system. In China, they've actually thrown even more at the system as a percentage of quote unquote GDP. And what I'd like Charles to comment on, because I'm very intrigued by this, is that the local governments have, I think the statistic I have here was over $600 billion in debt that has to get rolled over with the banks. And I'm sure the state's going to allow the banks to roll that debt over. But what happens when the real GDP in China continues to contract because the global economy is essentially choking on excess debt and austerity and regulation and all the other things that the wonderful forces around the world have done to try and, guarantee that they're going to get repaid. So in other words, I think China, in the 90s, they devalued their currency by a substantial amount. They reflated back out. There's a lot of people like Chanos and others in my industry that say that the non-performing loans on Chinese banks are significant, that they exceed the amount of reserves that they have at the central bank. And then secondly, their transition to a consumer-led economy or a much more kind of a free and open economy, it will be very, very, very disruptive. I have no doubt that China will eventually get it right. The question is, along this whole path of leaving this fixed investment to GDP bubble and trying to segue to something that's much more sustainable, that process, in my opinion, will be highly, highly disruptive because history has shown us that. And I don't think the Chinese are any different here.
Charles, do you want to comment on it?
Yeah, I think that Bill has a slide here called China Recovery ? That shows corporate debt in China as a percentage of GDP leads the world. And my takeaway from Bill's presentation here is he's highlighting how much debt there is in China. And, we always hear about how the Chinese are great savers, which is true. And we sort of tend to assume they're spending actual capital, saved, accumulated cash for all this stuff. But actually they've gone hog wild on debt. And so they've got huge corporate debt. They've got massive local government debt. They have a shadow banking system that no one on earth even knows the true size of. And on top of that, they have a system that is so opaque that there's risk just because we don't know how big their debt system really is.
Yeah, I think let's kind of continue along that path. I was in Singapore with Jimmy Rogers and a number of people maybe a year and a half ago. And one of the participants at this meeting was a banker from China. So we started talking at one of the large banks. We started talking about shadow banking, misallocation of capital, et cetera. And I think the main takeaway from that discussion was, I think Charles brought up, you have two worlds. You have the saver who really doesn't trust the stock market. Let's face it, the stock market has gone down significantly over the last 3 to 4 years. And that's something that we've actually been shorting, thinking that a lot of it was just illusionary and we couldn't get real clarity on the accounting. And then secondly, and so now they're also buying gold, and maybe Charles can comment on what percentage of the Chinese are actually buying physical gold. We hear all kinds of stories about, keeping money out of banks, keeping money out of the stock market. Maybe they're becoming apprehensive now about real estate. And so do they then default to physical gold? I actually think they probably will. But I think that the true level of debt in China to real economic output is probably well above 225%. I don't know the exact figure. I mean, I pressed Jim Rogers on this and others, and no one really wanted to respond. But if it's above 200%, then, and a lot of this went to, fixed investment, then my guess is that the hangover should be pretty significant.
Yeah, I think I think your conclusion is inescapable. And that, we also have to look at that, infrastructure. Michael Pettis, who has been in China for the last, I don't know, maybe a decade. He just wrote a long piece about that all infrastructure in China is not equal, and that in his sort of historical view of fast developing countries, he said there, actually history shows that you can reach a point where throwing money at infrastructure ends up being a malinvestment, because that infrastructure may not actually help the productivity of the entire economy. So we may be seeing an S curve here on infrastructure in China, where the initial, the first subway lines and the first fast railway lines and the first airports, all of that stuff created a great boost in terms of the productivity of the Chinese economy. But now when you're adding the third airport and the 22nd subway line and basically bridges to nowhere in Western China, then there may not be any productivity increase as a result of that. And so that's where we get the empty cities and the empty malls and the empty train stations, that you can't just pour money into infrastructure like willy-nilly and expect it to be productive. And I think that's maybe one of the underlying issues here in Bill's slides.
We had those big productivity gains in the 20s and the 30s because we invested in the infrastructure, and therefore our whole manufacturing, the system and the process was allowed to become even more functional. One of the comments that I'd make on this is, a matter of fact, we were mentioning before the show, my wife just returned from a month in Southeast Asia, and what she observed in Thailand and Myanmar specifically was really reinforced the point I'd make here is and I'm an old manufacturing guy from a long time ago, and the rate at which labor content in manufacturing is plummeting, whether you want to call it robots, Kanban, pull, jet systems, etc. So if you're running a manufacturing plant, and remember, we've had, 44 to 46,000 manufacturing facilities in North America since 1998 leave and go into Asia, and primarily China. Those manufacturing facilities themselves are requiring less and less labor every single day to be more productive. They're moving to robotics. They're moving to, they will be, to what they call lights out factories. So, they're still going to require labor, but they're running on a treadmill here that's running faster and faster. And so they're losing out to the other parts of Asia where there is more labor. It's leaving. It's forcing them into an incredible bind. And they have 50 million people, last time I heard, leaving the farms and moving to urban centers every year, and they expect the government to supply a job. That is a headwind that's going to create unbelievable social pressures in combination with these financial overexpending and malinvestment that they've made.
I'd like to ask Bill to comment on his slide, Turning Japanese, because I think that has a lot of, relating to the Japanese, even though they're a developed economy, that in some sense China may be following the Japanese into stagnation.
Japan are facing exactly what I just reflected on the productivity. Look what's happening to other auto industry, electronics industries, etc. Now that's a pricing game on the yen as much as anything.
I think what's so fascinating about the times that we're living in, and I think anyone both of you gentlemen have spent tremendous time on this, we are actually, I'm going to steal one of Charles' lines. We are reaching this end game, this kind of Keynesian end game, whereby debasement of paper money, trying to reflate back out, trying to support, various industry groups, all of that isn't working. And it's not working because essentially, this is, again, the Austrian theory, is that because we've subsidized and socialized credit for so long, that we took all this future demand that would typically happen in an unfettered world, and we essentially brought it to the present. And we allowed people to buy, $50,000 cars with 7-year, 8-year car payments. We allowed them to buy McMansions with 30-year mortgages, with interest-only mortgages. We essentially really distorted the whole supply-demand backdrop. And if you look at the Turning Japanese slide, essentially, you had a bubble in Japan. It burst. And instead of, and at the time, I think they had debt to GDP of about 65%. Instead of letting a lot of the banks go and liquidating the banks, and, we did the RTC where we liquidated all the S&Ls, and there was a cost to that, obviously, but it essentially paved the way for the next economic boom or turnaround, if you will. Japan decided not to do that. They kept trying to paper over it with a number of different schemes, very similar to what we're trying here in the U.S., fiscal monetary policy changes over time. And essentially what they did was they just destroyed, over time, the real economy. And the real economy, from a Japanese standpoint, was basically automobiles, electronics. That was the biggest part of their mercantilistic model. And, today we have over 40% debt to GDP. The bulk of the debt is held by Japanese insurance companies, the postal savings, any kind of government-induced retirement plan. And China, I think China doesn't have the options that they had back in the 90s. So in the 90s, they devalued the currency significantly. They reflated out. You also had kind of a global economic expansion going on, and they became, the manufacturer to the world. And that allowed them to essentially become, this huge mercantilist, success story, major reserves coming in the door. But they don't have that option anymore, because if they were to devalue the currency significantly again in this currency war that we're seeing around the world, I think that would then bring about more consumer inflation. I would say, and I'd love to get Charles' feedback on this, I think the number of protests in China have gone up significantly over the last 3 years. That was one of the things we discussed when I was in Singapore and Hong Kong a little over a year ago. So you have more social unrest, more friction at the local level. You have asset bubbles bursting, the stock market, global stock market, particularly in China, and then parts of the real estate market now that are leaking. And I know the government's trying to come in with these response mechanisms. They're, suggesting that they may run massive deficits to GDP this year to try and stimulate the economy. But I think, again, you get to the point where there's so much debt in the system, and there's so many unintended consequences showing up from the prior several episodes of, quote unquote, trying to rescue the system, that the new debt, the new injection really doesn't have an impact. It's the classic Austrian business theory. Murray Rothbard talked about this. To keep it going, the response mechanism has to be significantly greater than the prior response mechanism. And I just don't think that China will succeed here. In fact, I think they will fail miserably, and it will be very evident as we go through 2013 into 2014.
Herman King quietly said last week that printing more money is equivalent to running uphill. And that's what it becomes like, so he let that slip out. Bill, we have to break. Unfortunately, we're up against our hard line here. I'd really like to continue. Can you give us more time here this morning?
Absolutely.
Well, we're going to just take a short break, and we'll be right back.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.